since I'm at the Fed now, I have disclaimer. Nothing of what I say is representative of what the Fed thinks about things. I also have another disclaimer. We have a 4-month-old who refuses to sleep, so I might say things that make no sense whatsoever. I apologize for that in advance, and Christian or Dima, just stop me if I'm rambling around. All right, so this paper is about anomalies and risk adjustments. Okay, my job here introducing the paper is very simple because Turan did this presentation about a month ago, and nobody can do as well as a job as Turan at pitching papers. So the story is very simple. There's a bunch of papers that now study option returns. There's a bunch of papers that find large sources of predictability, but there are very few ways to risk adjust these returns. On the other side, there is pretty much a factor model for anything else in the world. So it makes sense to think about how to risk adjust option returns as well. The unofficial reason why we're doing this is that Amit and I have been trying to break our JFE paper for now 15 years. So this is attempt number 4. Is the first one that you guys see, but we have been scratching our head for a long time about this. So what do we do in this specific in this paper? We're going to focus on delta hedge call returns entirely in this presentation and mostly in the paper. Okay, so those are strategies that load on volatility. And we're going to develop a risk adjustment tool that is basically based on IPCA. IPCA was introduced by Kelly, Pruitt, and Sue. It's a very successful tool. Has been applied to a bunch of different other asset spaces. And I will try to explain, it's actually not as arcane as it might sound. It's a pretty simple tool. What we're going to find, okay, is that the IPCA model produces expected returns that are very close to realized returns. So most of the option trading strategies are going to display much smaller profitability than what you see on paper, and most of them become largely insignificant. Now, since there are competitors, I'm going to claim that we do a much better job than other factor models for options. Okay, so what are the competitors? Well, basically, you can think about this extended Palma and French factor model that Buchner and Kelly construct in their paper, where they study S&P 500 option returns. Okay, basically it's Thumb and French 5 plus momentum plus some embedded leverage factor from Terzini and Peterson plus some zero beta straddle from Goyal and Shumway. And then there is Bali, Kaosong, and Zan, which is now it used to be BCSZ, now it's BCCSZ because there is another author. I'm going to call this Turan's paper. Okay, so apologies to all the other co-authors, but Turan's paper is a lot easier than BCCSZ. So what do? They construct factors in the flavor of Thumb and French. Okay, so those are constructed directly from delta hedge core returns. Okay, by doing some double sorts. They have an option beta spread factor, some sort of a liquidity proxy. They have one spread portfolio that is constructed, again, double sort on option price, one on implied kurtosis, and one on RV minus IV. and then they have a market return, an option market return factor, which is basically a dollar open interest weighted average return of all the contract. Now, as I said, there are two versions of this paper that are all relatively recent. The one that Turan presented a couple of months ago has slightly two of the factors. There is a new factor, and one of them is a little bit different. Okay, so they only used to have modeled for implied kurtosis. Now they have a spread between realized and implied kurtosis, and they added a spread between realized and implied skewness. Okay, we have not updated the paper yet to reflect these changes, although we have checked, and it turns out that the changes that they've made impact the fit of the model only very, very little. Okay, so everything you see today is based on the old set of factors, but the new set of factors are relatively close. And then there is Horenstein, Vasquez, and Shao. Okay, I'm going to call this Aurelio's paper. Again, apologies to everybody else who is that paper. Where here they do something interesting because they basically take three spread portfolios. Okay, so those are again constructed by sorting stocks based on characteristics and then forming spread portfolios based on idiosyncratic volatility, the market cap of the equity, and the spread between realized and implied vol. And then they add an aggregate factor. Okay, so this is the return on a delta hedge call position on the S&P 500 at the money. Okay, so it's a mix of what, so you can think about this. In spirit, this is a lot closer to what Fam and French do, right? They have a big market portfolio, and then they have some spread portfolios. All right, so I said we do better than they do. What do I mean by that? Well, I'm going to show you the picture right away. Okay, so each dot is the return or the alpha according to the appropriate model, to the associated model of a test asset, which is a spread portfolio based on some characteristics. Okay, so the way you want to read this is that on the x-axis there is the return, on the y-axis there is alpha. If the dots line up with the 45-degree line, the model is not good. Okay, that's Fam and French plus. People are used to this, they've known this for a long time. If the dots line up with the horizontal axis, with the horizontal, sort of the zero line, then the model is doing very good. Okay, so visually, you can already tell that we're doing a lot better. Okay, so in the upper left corner, there is the fit on these 44 portfolios from IPCA. You see the dots most of the dots line up with the zero line. There are some that are off, but their alpha is a lot smaller than the realized return. And here is Turan's fit on the same portfolios. Okay, it's doing much better than the Fam and French factor, but there is still some lining up with the 45-degree line. And here is Aurelio's paper, who does a little bit better. Okay, there is more spread and they're more closer to zero. Still, visually, you can tell that IPCA is going to do a lot better. Okay, so first of all, what does it mean? Well, here there are many stories about why option returns are so large. If you want, there's many people in the audience that have written papers about liquidity and limits to arbitrage and that kind of story, okay, which is perfectly acceptable. The counterpart to this is that, well, we like to think that some of these returns are due to risk. And here we are sort of giving some evidence that there is, in fact, some risk to this being priced into the contract. Okay, so maybe the option market is not as inefficient as people used to think. Now, wait, what happened? Oh, okay. In this specific, okay, actually, let me stop. Are there questions, Christian?
I don't think there are questions at the moment.
Okay.
Everything is very clear.
All right. So data is the standard data that everybody uses. So this is all option metrics from 1996 to 2020. So here there are several different ways to do these things, and they actually do matter. And at some point, somebody has to write a paper that lines out the law of the land, if you want. So in our original paper, we were doing returns expiration to expiration, which I still think is the right way to do, but most people do month end to month end. So we're gonna do month end to month end mostly, although we have some robustness check that do expiration to expiration. So the contracts are all relatively short term. Okay, so this is month end to month end, they're about 50 days to maturity. They're all the same maturity in the cross section. Okay, so if you take a delta hedge on Dell and a delta hedge on Tesla, they're going to have the same maturity. Okay, we're going to apply the usual set of filters, and we're going to try to stay as close as possible to at the money at origination. Okay, so now as close as possible to at the money in index option means something, in stock options means something very different. Okay, because the strikes are so coarse that you had to choose different bins. Okay, again, like in our original paper, we were trying to be very, very close. Seems like people have chosen the 0.8, 1.2 interval is close enough. So that's what we're going to do as well. We're going to limit to positive volume and positive open interest at inception of the return. And then we're going to only take contracts for which the midpoint price is higher than 25 cents. Okay, just to avoid contracts that end up on the lower bound of quotes, which is 5 cents. All right, so everything else is from CRISPR and Compusted. We need test assets. Yep, go ahead.
Can I jump in on the previous slide? Any restrictions on the stocks that I included here? So like S&P 500 members or just any stocks?
Any stock.
Okay.
I think we have a filter on stock price as well, which is $3 or $5, but that's turns out that that's not as important. It kicks out very few stocks because the options that are listed, generally speaking, are all on big names and a few small names. So, but it's any stock. So there is also finance stocks. There is also all sort of anything in there.
Just a quick clarification while we're talking about the data. So when you're talking about moneyness, you're talking about strike over price, right?
Yes.
Yeah. So some authors, I know that Steve Igluski argues for this a lot, will use kind of transformations of delta or of D1 or something like this, where you kind of normalize things with respect to volatility. When you compare very different stocks one to another, maybe that would be kind of a good way to have something a bit more homogeneous in terms of moneyness, right?
Yeah, so we have played with all sorts of different ways of doing this, and maybe we'll add a table about this as well. It turns out that if you stay relatively close to at the money and relatively close to maturity, it doesn't make as much as a difference as you would think. But I mean, it's a valid point. if you want. Most people do strike over price, but we can. I doubt that it would make much of a difference.
Okay.
Also, because you will see the what you're talking about, the bias that you're talking about, we actually control on the left, on the right hand side. Okay.
Assuming that non-linearities are the ones that, you know, but sure.
Yeah. Okay. So one of the, well, I'm going to hold this for a few slides because it's a big selling point of this paper. So we need test assets. Okay, so we're going to collect a bunch of characteristics, and we're going to form portfolios based on these characteristics. Here again, it's all user stuff, usual stuff. There is contract characteristics. So those are on the particular contract that gets picked. Moneyness, beta spreads, open interest volume, all that kind of stuff. You'll notice one thing, that we only have option delta as a Greek. It turns out that, again, if you're staying close to the money and if you're close to maturity, sorting on gamma and vega is about the same as sorting on the stock price. Okay, so the correlation between those is like 99.9%. So because of the way IPCA is constructed, we had to kick out stuff that was very highly correlated. So we don't have higher Greeks. In case you were wondering what happened to them. There is risk neutral stuff, okay, implied everything. There's also implied volatility surface characteristics. Okay, we got a slope. This is close to maturity, out of the money minus at the money. And then there is an implied volatility term. Okay, this is Aurelio stuff. At the money, low maturity minus short maturity. There is physical characteristics. Okay, so those are all related to stock returns, volatility, autocorrelation, skewness, kurtosis, all that kind of stuff. And then there is predictors of stock return predictors. People have used those also to predict options. There are now a couple of papers in the RFS that do this. So we have included a bunch of this stuff as well. These are returns to long position. Okay, so note the delta hedge return definition has to be adjusted for the fact that otherwise you get a negative denominator. Okay, so is this the price of the delta hedge position at the end of the period minus the price of the delta hedge position at the beginning of the period? We're here going long, so you're buying the call, divided by the negative of the price of the delta hedge call today. Okay, so you have to do this, you have to switch this thing, otherwise you get random signs. I see there is a hand raised.
Yeah, please correct me if I don't see something. I don't see anywhere the beta. Isn't there no indication anyhow of, if you like, CAPM or something like this, a model underlying this empirical work? You don't have a beta, don't see a beta anywhere.
Yeah. So sorry, yeah, I got it. There is no beta in the character. It doesn't do anything.
And you know, and of course, there's no indication of idiosyncratic volatility and that kind of thing. So
there is an idiosyncratic vol is right down here.
Well, where is the beta then? Idiosyncratic volatility meaning what? Vis-a-vis what?
So yes, so idiosyncratic volatility is extracted from a market model.
Yeah.
Okay, but the beta in itself doesn't generate any spread. So if you sort stocks on beta and then try to construct a spread return in options, it doesn't spread.
Okay. So there is some kind of capital CAPM underlying there from which you extract only the idiosyncratic volatility.
Yes.
Oh. Okay, thanks.
And Alessio,
Yep.
Stephen H, which I tended to think is Steve Eston, is asking. Oh, okay. Amit has answered to Steve. So it's Rebalance Daily for the sake of people not following the the chat. So voila.
It's not Rebalance Daily.
Oh, it's not
Not
Rebalance.
rebalance daily. So
Oh,
this
okay,
is
it's a different-
static rebalancing. It's so there's no rebalancing. Okay, you
Hmm.
set up the position at the beginning of the month and you hold it until the end.
Okay.
Again, here matter of we could do daily rebalancing. Some people do. I understand the theoretical appeal of doing that. In practical terms, it again doesn't seem to make a heck of a lot of difference. So we were trying to do something that is simple that people can sort of easily replicate without having to jump through many hoops. Okay, so those are the return of the various. Those are 10-1 portfolios. Okay, which are not going to be the test assets. Our test assets are slightly different, but they are the type of characteristics that we use. Okay, we just print 10-1 portfolios because people are used to that. So there is the usual stuff that you think. Okay, so RV minus IV has a t-stat of 20, a returns of 3.5% per month. Aurelio, high vol term, has a return of 2.5% per month, a t-stat of 20. So very large sources of predictability. In case you're wondering, the stuff in bold is stuff that passes a multiple hypothesis threshold. Okay, so since I am a multiple hypothesis guy, this is exactly the context in which you would use that. You want to threshold all the t-stats that you get and allow for the fact that some of them will be significant, but probably they're not. They're only significant because you consider a bunch of them. Okay, so we got a bunch of them that are more than 1.96 that will be rejected by a multiple hypothesis thresholding. All right, so if we apply these either Turan's model or Aurelius model to these returns, what we're going to get is that most of them are left to be significant, although fair to be say Aurelio models does quite well. Okay, it leaves about 14 of them significant after MHT and 22 before. Okay, so that's a lot better than we used to have. So the implication is, okay, maybe there's a lot of inefficiency. All right, so what's IPCA? Think about this as a linear time series model. Okay, so you have the return on an asset that has a linear factor structure. Okay, where the factors are F, but the alpha and the betas are conditional on characteristics. Okay, so what's happening here is that these gamma functions, those are constant, but they give you a mapping from characteristics to betas. Okay, so they allow the betas to move around, but in a constant way. F are the latent factors that are unobservable. Okay, there are K of them for sake of simplicity. And now you want to estimate this thing. So how are you going to do this? Basically, this is very simple. Think about running a Fama Macbeth. Okay, first you run time series regressions. You get the betas. Then you run cross-sectional regressions of betas on expected return. Okay. Problem is the factors are unobservable. Okay, so what you're going to do, you're going to iterate. Think about some sort of a fixed point problem type of way. You keep running these regressions. You start with an initial set of factor realizations, and then you keep iterate until both the factors and the gammas converge. Okay, so you're going to have to specify some tolerance, and you stop when the change from the old gammas to the new gammas and the old factors to new factors is below your tolerance. It's fairly fast to do. It's just a bunch of OLS stuff. So there's nothing really complicated about this. Now, the way Brian, Kelly, and Steph have this set up, the estimation is done on managed portfolios. Okay, this is stuff that is becoming fairly popular in asset pricing. So what's a managed portfolio? Is basically a weighted portfolio of all returns, that is where the weight is given by one of the characteristics. So imagine that you sort all stocks, all option contract positions on the at the money implied vol, okay, and then you create a portfolio that is a weighted average of all the returns weighted by their implied volatilities at the money implied volatility. But we can evaluate the model also at the individual contract level. Okay, so this is going to give you an idea of how the model does when it tries to price the managed portfolios and how the model does when it tries to price the individual stocks, the individual contract position. The only, if you want, small hiccup of IPCA is that all the inference has to be done by Bootstrap, which turns out to be quite tricky. Okay. All right, so we're gonna evaluate these along 2 dimensions. Okay, one is total R squared. This is the standard definition of R squares. Is unadjusted. Okay, so this does not take into account degrees of freedom due to how many factors you have. And then we have this relative pricing error. Okay, so this is the sum of the square of all the alphas divided by the sum of the squares of all the average returns. Okay. All right, so now the real important questions and the biggest selling point of this paper is why you want to do this. Okay, why just not do what Turan and Aurelio are doing? Okay, form portfolios the way we are used to use those as factors and then price other assets. Well, one big difference here is that the structure is very, very flexible. Okay, this allows you to do all sorts of things that you cannot do with a static factor model. For sure, you can allow for time varying betas. Now we know, and we've known this for a long time, that you can price an option with CAPM on a 1-period model. But the moment you go from 1 period to a multi-period model, it doesn't work anymore. Okay, so having static betas isn't going to help you much. Having dynamic betas certainly is an attractive feature. Now, it goes a little bit deeper than that, okay, in the sense that one of the problems, if you guys have played with this stuff, is that option returns are all slightly different, even if they're supposed to pick up the same thing. So, for example, if I take a delta hedge call at the money 1 month to maturity, theoretically speaking, that should be about the same return, although of a different magnitude of not the money straddle. But it turns out it's not. Okay. Similarly, the return on a delta hedge call should be about the same as the return of delta hedge put, but it's not. Okay. So when you do these sortings, you will see that if you sort on the same variable, sometimes you get a significant return on a delta hedge call, but you don't get that on the straddle. You might not get it on the delta hedge put. And then once you lay on top of it moneyness and maturity, okay, now it becomes very complicated. So in other words, if you building static portfolios, you're going to have to do one set of static portfolios for every class of option contract moneyness maturity combination that you're interested in. Okay, so you're going to have one model for at the money delta hedge calls, one model for at the money straddles, one model for at the money straddles with long maturities. IPCA allows to pack all of this together, okay? Because all these characteristics are controlled in the beta. The beta is allowed to vary according to all these characteristics. So basically, you can have one set of factors, the price is everything, where all the sort of the adjustments between one type of contract and the other are taken care by the betas. And going back to Christian's comment, you don't have to stick with linear betas either. We use linear betas, but you can have any sort of functional formula you want. Okay, now we did not invent IPCA. Okay, so this is not our contribution. The thing is that IPCA has been used for a bunch of other asset classes. It's very hard to beat in terms of pricing errors, but it's particularly useful. It almost feels like people should have started looking at how PCA did on the option return data, because that's where multidimensionality of characteristics really plays an important role. Okay. So from a conceptual point of view, I think you really want to do this rather than writing down spread portfolios. All right, so one thing that is, okay, sorry, Christian, are there any questions?
No,
Okay.
we're still good.
All right, so since the factors are latent, one problem is how do you pick factors? You want 3, 4, 5, 7, 10,000 factors. So the way this is done is basically a fairly simple, intuitive procedure. You run the model constraining the alpha to be 0, okay? And then you run the model allowing the alpha not to be 0, okay? And then you pick the number of factors that minimize the distance between the fit of the two models, okay? So the optimal number of factors would be the one for which the model, the constrained model, the one without an alpha, is undistinguishable from the unconstrained model, the one with an alpha, okay? In our case, that's gonna happen at about 4 factors. All right, so how does the model do? Again, as I said before, for estimation purposes, the model is estimated on managed portfolios, okay? So what you see is that the R-square is monotonically increasing with number of factors. This is not surprising because, again, remember, this is unadjusted R-square. But the pricing error kind of finds a minimum and then it stays there. Okay, after so many factors, you're not adding much. Or in our particular case, you might even hurt yourself a little bit. When you go to the stock level position, what you see is that the pricing errors are a lot larger. Okay, so on a managed portfolio, in the managed portfolio space, this fit in sample eliminates almost all pricing error. Okay, the pricing error is basically 0. If you go to the stock option level, you see there's still a very large pricing error. And also, obviously, the R-square is going to be a lot lower. So the K number 4 factor is going to be our reference IPCA model. Okay, we're going to go on with that. Now I'm going to sort of run another horse race. Okay, so in the picture that I showed you before, this is a model horse race. Okay, this is our model taken as it is against Turan's model or Aurelio's model taken as they are. Problem is we have dynamic betas, they don't. Okay, so what we're going to do, we're gonna take their factors and allow the betas to be dynamic. Okay, we're gonna estimate for each one of the cases what the proper gamma function is. Okay, so we're going to put everything on equal footing here. In essence, we're only evaluating the factors here, not the model, only the factors. Okay, and because I show you in sample stuff before, here I'm going to show you out of sample. Okay, so what do you see? Again, let's start from managed portfolios. IPCA is going to do a much better job in terms of pricing errors. Okay, although again, noticeably, Aurelio's model does quite well. The R squares are a lot higher. If you go to the stock level, again, R squares a lot higher for IPCA. Pricing errors here, they're a lot closer. As a matter of fact, Aurelio's model does just a little bit tiny better. Okay. People like to look at Sharpe ratios, okay, because that, again, all the tangency portfolio that is spanned by the factors, okay, as a measure, as a summary measure of how well the model is going to do. And again, here you see the IPCA factors have a slightly higher Sharpe ratio, much higher than Farmer Friends factor, much higher than Turan's factors, and higher but not completely. We're not kicking Aurelio's model out of the park yet. All right, so
I'll yeah, Aurelio was asking or noting that the approach that you're taking is very statistical, right? As compared to Turan's or Aurelio's papers where they have kind of tractable factors. So, you know,
again, like let's go back to what I said before. I mean, you're completely correct. Okay, so it's always nicer to have a model, but it really depends what you pay for it. And in this particular case, what you pay for it is that you would have to have a different theoretical model for every different asset class, because the factors that are spit out by their theoretical intuition when transported into the empirical space are going to be very different if you're dealing with short maturity, long maturity, at the money, out of the money. So it's at some point, it's a little bit of a trade-off here.
Yeah, okay, so let me kind of rephrase. So the way I see it, so my question is, it's using IPCA, right? What you end up finding is that very nonlinear combinations of managed portfolios are the best way to explain returns on options.
Mm-hmm.
But then I need to understand what are these managed portfolios and how the nonlinear loadings unfold through times to really understand what are option returns, right? So it's very difficult to gain an economic intuition of what are the channels driving option returns in this statistical framework. I understand. I totally agree with you. If my goal is simply to have kind of the best fit possible for XYZ reason, then it seems that's the way to go, right? But if I want to understand the economics of it, it's a bit more challenging, at least to my kind of limited brain, no?
Well, so it depends how much time you want to spend staring at your screen. Okay, so that's the first answer.
As little as possible.
Well, then that's on you, not on me. But the other thing again is like, look, it's nice that you can relate option returns to moments of distributions. Okay. As a matter of fact, as I mentioned at the beginning, this is attempt number 4. Attempt number 3 was exactly, we tried to do that. Okay. We were not as elegant in writing down a model as Turan or Aurelio's are. But the point is that doesn't really work. So you can have a nice tool, a nice framework, but if it doesn't work, it doesn't work. I don't know what to tell you. You know, it would be great if CAPM worked. Unfortunately, it doesn't. So do you want to price the stuff or not? I don't know.
And if I may just jump in just for one thing, I mean, it's a fair points that Aurelio and Christian you're making. I mean, completely fine because it is kind of a PCA, and the onus is on us to provide, what these latent factors are. That is our job, and I'm sure Alessio will get to it to a little bit, right? It is still going to be latent, but we will try to relate it to some economic observables and try to tell you what those factors are. So it's not totally black boxing.
Perfect.
And we're
So
going to
let
get
Aurelio get to it.
as you see on the screen, that was the next slide. Okay, so what are the factors? So we do a couple of things. Okay, the simplest thing we do is, okay, I'm going to take our factors and regress them on the compilation of other factors that people have. Okay, so basically this is a giant time series regression. Okay, there are also the Fam and French plus factor. Turns out none of them does anything. So you see there is a big blank because I couldn't fit that table in the page. Okay, the first block here is basically Turan's model. This block here is Aurelio's model. They share an RV minus IV factor, although this is it's constructed in a slightly different way in the two papers. Okay, so here I think we are including the Turan's version, so the double sorted a la Fam and French. But again, they're very, very close. So if I take our first IPCA factor, what you see is that it seems to be very highly correlated with this RV minus IV factor. Okay, it's very highly correlated with the idiosyncratic volatility factor. Okay, and maybe that also explains why Aurelio's paper is doing so well, Aurelio's model, is because the first factor, the first IPCA factor, is the one that has the highest premium. Okay, so this is going to account for most of the tangency portfolio Sharpe ratio, and it's closely associated with two of their factors. If I take the second factor, our second factor, it loads again on Aurelio market cap factor. It loads a little less on Turan's liquidity factor. Okay, so again, here you can, these market cap and liquidity are somewhat very highly correlated. So you can think of the second factor as a liquidity IPCA factor. And then the third and the fourth factor are basically somewhat a combination of the aggregate option market and sort of variation in returns on the delta hedge, the S&P 500 delta hedge return. So now, although by the time you get here, those are very small contribution to the total spanning. One thing you notice is that the R-square, they're high, but they're not 1. Okay, so the IPCA factor contains a lot of orthogonal stuff to this other set of factors. And maybe the harder question here now is, okay, so if you're writing down a risk factor model, it has to be related to some aggregate risk. Okay, so you can't just say, okay, RV minus IV spread portfolio is aggregate risk. I don't know that. Okay, so if you want, I could flip the same criticism on Aurelio's and Turan as well. Their factors are spread portfolios, but it's not at all clear what aggregate risk factors they load on. Okay, so we try to somehow address that, although admittedly this is a very hard question to get to. It's hard because the base assets here, the returns, are at least ex ante neutral to movement in the underlying. So it's hard to connect to sort of what we think about macroeconomic risk, which are typically linear, if you want, in the underlying, the stock market or GDP or stuff like that. Our returns are mostly volatility bets. So you need to think a little bit more creatively. So what we do, we try to relate the factors to aggregate moments, all the moments, not just the first one, okay? And in essence here, what we're going after is tail risk events of some sort, okay? Now there's a very nice paper again by Brian Kelly and Brian, oh, I forgot the second author, but anyway, it's 2014 RFS, where he constructs a tail risk measure. Okay, so what we're going to do is basically look at the realizations of the factors, of the IPCA factors, when there is particular market conditions. Okay, and basically consider two things. One, if you want, is first and second moment, and another group is like higher moments. Okay, so we look at how the factor does when the aggregate stock market return is low. Okay, and what this table gives you, this is the mean realization of the factor, and the t-stat measures the difference in mean of this mean relative to the unconditional mean in the entire sample. Okay, so significant t-stat tells you that the realization of the factor in that particular event is different than the average realization of the factor. Okay, so we got low market return, recessions, those are sort of linear, if you want, first moment type of stuff. We get large changes in VIX. Again, we didn't invent this, they come straight from Brian's paper on the S&P 500 return, S&P 500 option return. And then we added some other finer measure of tail risk. Okay, so we got Keyes measure of tail risk, which is computed on the cross-section of stock returns. And then we got skewness and kurtosis of the S&P 500 model-free extracted from S&P 500 options. Okay, so what you see here is that the first factor does worse when you have high realization of either skewness, kurtosis, or tail risk. Okay, so this is telling you when the distribution is very much, the tail of the distribution becomes very important, then the factor does worse. Okay, so if you want to think about this as the first factor as loading being a tail risk factor, this is what our argument would be, that it is because its realization is low when you have high uncertainty about the distribution. Second factor seems to be linearly related to, so the first two moments, okay, whether it's low market return, recession, or big changes in VIX, okay. Then the third factor, again, seems to be positively related to first two moments, and the fourth factor seems to be, again, negatively related to tail risk events. So the first and the fourth factor, if you want, are tail risk factors from an aggregate point of view. So they show up when tail events in the aggregate economy are more important. And the third and second factor are hedges. Okay, they do well when you have either low market returns or large jumps in volatility. All right, so the next question that you have, how am I doing on time?
Oops, you still have roughly 10 minutes.
Okay, we're gonna be good. So the next question that you asked, Christian, was that, okay, what about the characteristics? So we know that a lot of what is driving this doesn't come from the factors themselves, but it comes from the betas. Okay, so something that is worth asking is that what characteristics matter the most for the betas? Okay, so what we do here, we basically add up the gammas. So the gammas are the function that maps characteristics into betas. Those are constant. Okay. For the 4 factors, each factor has a different set of gammas. So for each characteristics, we add up the absolute value of the gammas across the factors, and then we order them in terms of magnitude. And the idea here is that the higher the gamma, the absolute gamma is, the more important that characteristic is to determine the beta of the factor. We aggregate so that you get a synthetic one measure number for all the factors, all the 4 factors. And what you see, okay, is something maybe not particularly surprising. Okay, one is, it's RV minus IV drives a lot. Okay, it drives the betas, it drives the factors, it drives everything. But then there are other things that are very important, right? Remember here, we're trying to stay very close to at the money, okay, between 0.28 and 1.2, but you still get a big spread in moneyness in that interval. And in fact, the moneyness, or Christian, as you would like it, the delta, okay, is very important in adjusting how the beta of any particular security to that factor behaves in the cross-section and through time. Okay, so this is all stuff you cannot do with a traditional static factor model. Okay, somewhat surprisingly is that, for example, liquidity doesn't seem to impact much. It creates one of the factors seems to be a liquidity factor, but liquidity of the contracts don't seem to sort of matter much for the betas. Okay, so you might have the impression that everything is driven by RV minus IV, but it's not like that. Okay, in the sense that there are other dimensions of either in the factor space or in the beta space that actually matter in a non-obvious way. Okay, so what is left? Well, basically, I'm going back to the first picture that I show you, but just focusing on IPCA. Okay, again, IPCA is fit on managed portfolios, and you see here they do very well. When you put it only on 10-1 portfolios that only use 20% of the data, okay, so those are the corners, you see that even IPCA can now price some stuff, okay? Even if you take RV minus IV portfolios, the beta is, the alpha is a lot smaller, it's like more than 3.5 times smaller, okay? It goes from 3.5% to about 1% per month, but it's still somewhat significant. Similarly, the IV term, Aurelio stuff, is still significant. Okay. Now, when I put it in this space, RV minus IV gets priced out if I weigh all the stocks. But Aurelio, you'd be happy to know the IV term is still significant. Okay. So there is something about the term spread and implied vols that is very hard to price. And it's surprising to me that that didn't show up as one of the factors. Okay, we try to see if there is a correlation there, but there is not. So it's a very idiosyncratic type of information. All right, so I already talked all about this. We do a bunch of robustness checks, as you might imagine. If you read the paper and you think about something, please send me an email. Would love to do more robustness checks. I'm going to close it up. So turns out that explaining option returns is very hard, even with a tool as flexible as IPCA. You explain away most of it. There's still some particular trading strategies that are very hard to price. Okay. And in these, if you want something that we didn't have time to explore, is that, and this is one of the things that I was talking about before, delta hedge calls are even easy to price. If you try to price straddles, then it becomes really hard. The straddles are a lot more volatile than delta hedge calls or delta hedge puts, and they're a lot harder to price. So we try to accumulate to sort of unify all the knowledge, the cross-section, predictability in option returns with sort of modern asset pricing models into this IPCA exercise. I think we show that a lot of variability can be explained. Some of it, you probably again require to go back to some sort of limit to arbitrage explanation. So the liquidity might be driving everything there. But I think we managed at least to make a big stab at it. And I'm going to close like that.
Excellent. Thank you very much. So Steve H has a lot of questions in the chat. Maybe he's ready to unmic to open his mic now. Or not, someone else?
Oh, that's the way you do it. I see. Okay, so I'm reading.
Yeah, I can read it for you if you want to.
No, I managed to untoggle the chat. So there seems to be some.
Amit got back to Steve on many of the points. So I was just wondering if Steve was willing to continue the discussion with open mic. Otherwise, the floor is open for questions. Well, apparently everything has been asked or discussed in the chat. It's a very interesting paper. Thank you very much, Alessio. I was not at all kind of criticizing the approach. I just think that the two are serving different objective functions. That's basically kind of the point I was trying to make. But you're making a fair point that we can understand a lot by looking at the